The global economy is desperately in search of some positivity, so they generally point to the fraudulent GDP numbers, low inflation numbers, or perhaps the unemployment numbers that are in fact proven to be false. So today we will discuss the 13 charts that show economic disaster. You came here for the truth, so let me unveil that for you. I want to get into a few charts today and really connect the dots into what it all means, because just looking at the charts is simply not enough. Let's begin with this. A lot of this is out of Street Talk Live, but we're going to connect it into some other details, showing you the Gallup poll of economic confidence. And you're seeing this from the beginning of the year, where we have a decline ever since. Now, they make the note here, just the weather, and I would have to emphasize the fact that in most cases, although they do blame the terrible conditions on weather, that really doesn't have as much of an effect, for the most part, as they say it does. So they just use it as an excuse. This has been done over and over again, but I would definitely have to say that historically, we never really read about this so much. It is only in the past few years since the financial crisis when they use these methods of distraction. That's what the mainstream media is so good for. I would also have to note the fact that in 2014, look at the economic confidence growing. But the reality is that there really wasn't any confidence to begin with. I have more information about that in a moment. These 9 charts right here, all showing you the same thing. If you can't see the actual writing here, you're looking at the Russell 2000, the S&P, the NYSE, and other stock markets, and what we're looking at is the same sort of decline occurring at the exact same time. Very interesting to note, all of these essentially are connected together. Ever since the year 2000, stock markets generally move in sync with each other. Prior to that, it was definitely an independent system for the most part. However, since the year 2000, pretty much everything has been moving together. When there is lack of confidence, and that's real confidence, then the markets would move downward. When there is confidence, the markets move upward. So this is very different now from what we have seen historically, simply because all of these stock markets, the bond markets, and everything, all connected all down the way, are fraudulent. And I don't say this lightly, I mean this specifically, that these markets are controlled by computer algorithms. If you think that the fundamentals of investing have much to do with the price of a particular stock or what the stock market is at, you really need to sit down and look at this truth. This is what we're not getting into the mainstream media, certainly, and a lot of the alternative news is still trying to find the truth out there, but amidst all of this falsehood. Growth of $10,000 strong versus weak periods, and you can see the seasonally strong period and then the seasonally weak period. What does this all mean? This is completely insignificant to what we need to be addressing. Yes, there is massive divergence here, but we need to look at the real economy. Let's move into that. First, I want to get into this chart just very quickly, showing you a decline. We're looking at Sell-In-May PortfolioReturns. Does this really matter in the grand scheme of things when it's all controlled and contrived anyway? I want to connect it in with this United States consumer sentiment. You can see that since the financial crisis, it has been a little bit volatile, but certainly has increased. This is when you know that this system is not real. There is, in fact, no increase in consumer confidence. The only time we had a boost in consumer confidence was when the government handed out the TARP money and they had the Cash for Clunkers program, and they were simply handing out money to each and every person, indirectly or directly. And this, of course, has a direct benefit to the economy. Most of it gets wasted along the way, in between the time where it leaves the government's hands and how all the things that need to go along the way, until it actually ends up in the individual's bank accounts. This generally wastes more money than it actually produces throughout the economy, but it is a direct boost, regardless of the effects of it. Now, when you print up money, when you use the QE programs, that's not going to assist it at all. So generally, I would say that there has been very little boost to the economy at all since the financial crisis, despite the fact that trillions of dollars have been printed. So look at this stat right here, going to show you that most of these charts, even though I'm showing you them and they are important, they are really insignificant in compared to the reality and the truth which lies behind them. So yes, it's important to analyze these, get as many different indicators as we can, but look at the truth behind. Understand what they're really telling you, not just numbers on the charts themselves. Let's look at this. Out of Bloomberg, almost $100 million worth of options pegged to volatility in U.S. equities changed hands in a split second today in Chicago. Transactions that would together represent more than half a day's normal volume. Can you believe this? Half a day's normal volume in a split second. What does that tell you about the markets? Number one, they can be completely manipulated by an algorithm on a computer. We've seen that with the flash crash, 1,000 points down on the stock market virtually instantly and then a rise back up. What does this mean? Look at all the stock markets that completely shut down for a short period of time, all because of computer glitches. What about the people's bank accounts that read $0 at some point because of computer glitches? We're putting them in charge using all these computer algorithms, and they are destined to fail. They have already begun to fail, and we will encounter this in the future. Now let's talk a little bit about the VIX. Buying a call on the VIX is a bet that the equity market turbulence will rise, which usually happens when stocks fall. This individual here said that the trades had characteristics of someone hedging stocks. Very well could be. I'm not denying that. But what does this tell you about the fragility of the market itself? See, this is what we need to understand. You read an article, you take the information in, it's very good. But what does it tell you about the stability of this market? And the fact is that there is no stability. It's all fraudulent. They're trying to make you believe it, but in fact there isn't any, and this is just one very good example of that. Annual percentage change in imports and exports. Multiple times happened before. Is this time different? That's what they're asking here, and of course sarcastically, because every time it continues to happen again. This is a set of repeated patterns that occur over and over again. Historically, you can see this through the shorter cycles like we are seeing on this chart here, but you can also look at the Elliott wave or the long wave theories. You can look at the Kondratiev wave. There are so many different ones where we have literally hundreds of years and they show these cycles that repeat over and over again, and this can be seen. Really good information. My favorite book on that, which I've mentioned before, is At the Crest of the Tidal Wave by Robert Prechter. Excellent book to show you these different charts and different cycles. Like I said, very important information, but we need to look at the deeper intelligence that goes beyond this. Right here out of Bloomberg, why would anyone want to restart the credit default swaps market? Well, I'll stop you right there. They want to make money. That's what this is all about. But then you look deeper into it, and what happened with Greece? So let's read this part here. In an environment where it's difficult to buy and sell cash bonds, derivatives tied to such debt can be a handy substitution. And to some extent, investors have already turned to credit derivatives as a way to making up for the lack of liquidity in the overall bond market. So when you're not getting the yield that you want, you have to turn to a risky alternative. And as if bonds, which I talked about in my book, weren't risky enough, they had to actually go in and increase this even more. we're looking at a time when derivatives caused such a massive problem in this crisis, in the financial crisis. As I said, I talked about it in my book, and essentially what I've said here is that we have the alphabet soup of trash. And you're looking at asset-backed securities, you're looking at all of the different mortgage-backed securities, you're looking at credit default swaps and collateralized debt obligations, CDO cubed, CDO squared, and so on and so forth. All of these added up, which I call the alphabet soup of trash, and it allows them to expand on their gambling, essentially. But it doesn't look very good when you enter into a problem like we had with the financial crisis. This is why that was caused. And if we expand on that, what they're talking about in this article here is that Greece's problem was primarily triggered by these derivatives, credit default swaps. And we're heading into the same direction once again. Individuals are looking for greater and greater profits, and they can do so by taking on more risk. In this case here, they are supposed to be used to hedge their risk, but of course, just like anything else, it gets out of proportion, it gets totally dismantled, and here they are being used just as another method of gambling. All derivatives are nothing but garbage that cannot be denied. If you found this video informative, please give me a thumbs up. And I just wanted to say that if you like this information, I am sure that you will enjoy my book, The Money GPS. If you wanted to flip through it, all you need to do is go over to Amazon and you can actually flip through it on there and see if you like it. I would also note that I've been working a lot on the website, so themoneygps.com, of course, and it's taking up a lot of my time, so I haven't been able to make a video every single day, but I've certainly been trying hard, and there's a lot of work being done there. I did a promotional video recently about that, and I'm just trying to get the website all sorted out so that I don't need to do any more maintenance on it. I can just do the YouTube videos, focus on that, and just worry about that, because that's really what my primary goal is. I have so many different projects that are on the go, but making a YouTube video is actually number one. So I put everything else on the back burner for the most part in order to get the YouTube videos done, simply because I have so many people asking questions, and I'm always trying to answer the questions as I'm going through the videos. So that's always in the back of my head. Remember that if you are commenting on the videos, I do read the comments. Can't get back to every single comment, but I do get back to all my emails. So if you want to email me, the best place to get me is at david@themoneygps.com. Take care.